The Stoic Investor, Mastering Market Volatility with Ancient Wisdom. Siba. Introduction. The financial markets are a tempest of uncertainty, a relentless force that rewards the disciplined and punishes the impulsive. Every day, investors face the same brutal realities. Markets rise and fall without warning. Fortunes are made and lost in moments, and emotions run high. Yet amidst this chaos, there exists a group of individuals who remain unshaken. These are the Stoic investors. Stoicism, an ancient philosophy forged in the fires of adversity, teaches the art of mastering one's emotions, focusing on what can be controlled and accepting what cannot. For the modern investor, these principles are not mere intellectual exercises, they are survival tools. A Stoic investor does not panic when the market crashes, nor do they grow reckless during euphoric bull runs. Instead, they adhere to a disciplined, rational approach, turning volatility into opportunity and fear into strategy. This book is a guide to investing like a Stoic. Whether you are a seasoned trader, a long-term investor, or someone just beginning their financial journey, the principles within these pages will arm you with the mental resilience to navigate the markets with clarity and confidence. You will learn how to control your emotions. When others are driven by fear or greed, focus on what you can control. Ignoring the noise of the market, turn losses into lessons. Using setbacks as stepping stones rather than failures. Develop unshakable patience. Resisting the temptations of short-term speculation. By the end of this book, you will not only be a better investor, you will be a calmer, wiser, and more resilient one. Chapter 1. The Foundations of Stoic Investing. 1.1. What is Stoicism? Stoicism is a philosophy that originated in ancient Greece, later refined by Roman thinkers such as Seneca, Epictetus, and Marcus Aurelius. At its core, Stoicism teaches that true strength comes from self-control, rational thinking, and the acceptance of events beyond our power. For the investor, this translates to a simple but profound truth. You cannot control the market, but you can control how you respond to it. The Stoic investor does not deny the reality of market volatility, they embrace it. They understand that crashes, bubbles, and unpredictable swings are inherent to investing. Rather than reacting emotionally, they rely on preparation, discipline, and a clear strategy. 1.2. The Stoic Investor's Mindset. The difference between an average investor and a Stoic investor lies in mindset. Ameda Kartum. 1.2.1. Control the controllable. What you cannot control: market crashes, economic recessions, political instability, interest rate changes. What you can control: your asset allocation, your risk management, your entry and exit strategies, your emotional discipline. Diaz. 1.2.2. Ignore the uncontrollable. Most investors waste energy worrying about factors beyond their influence. The Stoic approach is simple. Focus only on what you can change. For example, instead of panicking over a market downturn, a Stoic investor asks, "Is my portfolio diversified? Asterisk, do I have cash reserves to capitalize on undervalued opportunities? Asterisk, am I sticking to my long-term plan? Asterisk." 1.2.3. Embrace volatility as opportunity. Market turbulence is inevitable. The Stoic does not fear it. They prepare for it. Historical example: Warren Buffett during the 2008 financial crisis. While others sold in panic, he invested billions in undervalued companies like Goldman Sachs and Bank of America, reaping massive gains in the recovery. Yopwa Chapas. 1.3. Why most investors fail and how Stoics avoid it. The majority of investors lose money not because of bad luck, but because of psychological mistakes. 1.3.1. Emotional trading. Fear, selling in panic during a crash. Greed, FOMO buying into bubbles, e.g. Bitcoin in 2017, meme stocks in 2021. Stoic antidote. Preset rules. E.g., I will only sell if fundamentals deteriorate, not because of price drops. 1.3.2 Overconfidence. Many investors believe past success guarantees future gains. Example: hedge funds that thrived in the 1990s but collapsed in the 2000 dot-com crash. Stoic antidote. Humility. Always assume you could be wrong. 1.3.3 Short-term thinking. The average investor holds a stock for less than a year. The Stoic investor thinks in decades. Example: John Bogle's index fund strategy. Simple, patient, and consistently profitable. 1.4 Historical case study. Marcus Aurelius as an investor. If the Roman Emperor Marcus Aurelius were alive today, how would he invest? Long-term focus. His reign lasted 19 years, no short-term gambles. Indifference to public opinion. He ruled during plagues and wars, yet remained rational. Adaptability. His philosophy emphasized resilience, not rigidity. 1.5 Practical exercise. The Stoic Investing Journal. Stoics practiced journaling, a habit of recording thoughts, mistakes, and lessons. Your task: 1. Write down your biggest investing mistake. 2. What emotion drove it? Fear, greed, impatience. 3. How could Stoic principles have prevented it? This chapter continues with further case studies, psychological research on investor behavior, and Stoic mental exercises. Chapter 2. The dichotomy of control in investing. 2.1 The Stoic principle of control. Epictetus, the former slave-turned-Stoic philosopher, famously said, "Some things are within our power, while others are not." Asterisk: for the investor, this wisdom is paramount. Most financial stress comes from misplaced focus, worrying about external events rather than refining one's own strategy. 2.1.1 What you can control. Your knowledge, continuous learning about markets and economics. Your habits, discipline in research, execution, and review. Your reactions, choosing logic over emotion. 2.1.2 What you cannot control. Market movements. No one can predict short-term swings. Media hype. Sensationalist headlines designed to provoke reactions. Others' actions. Herd behavior often defies logic. 2.2 Applying the dichotomy to your portfolio. A practical exercise. 1. List your current investing worries. 2. Categorize them: controllable versus uncontrollable. 3. For the uncontrollable, accept them and shift focus to actionable steps. Example: uncontrollable. The Fed might raise interest rates. Controllable. I can adjust my bond holdings or diversify into inflation-resistant assets. 2.3 Case study. Ray Dalio and radical acceptance. Ray Dalio, founder of Bridgewater Associates, embodies Stoic principles in investing. His all-weather portfolio is designed to perform regardless of market conditions, a perfect example of focusing on what can be controlled. Key takeaways: prepare for all scenarios, not just optimistic ones. Accept uncertainty. Build systems that thrive in chaos. Chapter continues with risk management frameworks, psychological biases, and Stoic journaling prompts. Chapter 3. Amor Fati, Loving Your Investment Fate. Dafatrasum 3.1 The Stoic Art of Embracing Outcomes. Amor Fati, Latin for love of fate, is the Stoic practice of accepting, even embracing, whatever happens, good or bad. For investors, this means viewing losses not as failures, but as necessary lessons. Market downturns are inevitable. The Stoic does not rage against them but asks, how can I adapt? Asterisk. Example. George Soros famously said, it's not whether you're right or wrong, but how much you make when you're right and how much you lose when you're wrong. Asterisk. 3.2. The Anti-Fragile Investor, Nassim Taleb's Framework. Nassim Taleb's concept of anti-fragility, systems that gain from chaos, aligns perfectly with Stoic investing. Fragile investors break under pressure, panic selling. Robust investors withstand pressure, hold steady. Anti-fragile investors profit from pressure, buy undervalued assets during crashes. Case study. In 2020, during the COVID crash, anti-fragile investors loaded up on stocks like Zoom, Amazon, and Tesla, which thrived in the new environment. 3.3 Practical Exercise, the Premeditatio Malorum Drill. Stoics practiced premeditatio malorum, premeditation of evils. 1. Imagine the worst-case scenario, e.g., a 50% market drop. 2. Ask yourself, how would I respond? Asterisk. What opportunities would arise? Asterisk. 3. Plan ahead, e.g., keep cash reserves for buying opportunities. Chapter 4. Memento Mori, the investor's mortality check. Demanda Orha. 4.1. How contemplating death improves investing. Memento Mori, remember you must die, reminds us of life's brevity, a powerful tool against short-termism. Legacy mindset, build wealth for decades, not days. Example, Warren Buffett's 20-year punch card. Rule, imagine you could only make 20 investments in your lifetime. Would you trade so recklessly? Asterisk. 4.2. The long-term compounding mindset. Stoic investors ignore quarterly earnings hype. They focus on businesses that grow over generations, e.g., Coca-Cola, Apple. Data point. $10,000 invested in the S&P 500 in 1980 would be worth over $1 million today, with no trading required. David does. Hos. 4.3 Exercise. Write your investing epitaph. 1. Imagine your obituary as an investor. 2. What do you want it to say? He chased hot stocks and died broke. Or she built lasting wealth through patience. Chapter 5. The Discipline of Asset Allocation. Nidachas. 5.1. The Stoic Portfolio Structure. A Stoic portfolio is diversified, balanced, and emotionless. 60-40. Rule, 60% stocks, 40% bonds. Adjust for risk tolerance. Golden Rule. Never let a single asset exceed 10% of your portfolio. Motralagar Senambiyun. 5.2. Case Study, the Permanent Portfolio. Harry Brown's Permanent Portfolio. 25% stocks, 25% bonds, 25% gold, 25% cash, thrives in any economy. Growth. Stocks rise. Recession. Bonds and cash stabilize. Inflation. Gold soars. 5.3. The Rebalance Ritual. Stoics rebalance ruthlessly and without emotion. Sell high, trim winners. Buy low, add to losers. Example, in 2008, rebalancers sold bonds, which rallied, to buy stocks, which crashed, locking in huge future gains. Chapter 6. The Stoics' Edge in Behavioral Finance. Parjazasal U. 6.1. Cognitive biases that destroy investors. Confirmation bias, only seeking info that supports your views. Anchoring, overvaluing initial information, e.g. IPO price. Recency bias, assuming recent trends will continue. Namalan Shimandrasam. 6.2. The Stoic Antidotes. Journal your trades. Spot emotional patterns. Seek disconfirming evidence. Play devil's advocate. Delay decisions. Sleep on big moves. Study. Traders who journaled outperformed peers by 23% annually. UC Berkeley Research. Chapter 7. The Stoics' Daily Routine. 7.1 Morning Preparation. Review your rules. E.g., I only trade after 10 a.m. Read market history. Remind yourself of past crashes, recoveries. 7.2 Evening Review. What went well? What was emotional? What's the plan tomorrow? Example. Ray Dalio's Pain plus reflection equals progress. Mantra. Chapter 8. The Stoic Investor's Crisis Playbook, Thriving in Market Chaos. Nizakaso. 8.1 The Anatomy of a Financial Crisis. Financial crises follow predictable psychological patterns: denial, panic, capitulation, and renewal. Stoic investors recognize these phases and prepare accordingly. Historical case study: 2008 financial crisis. Denial phase: 2007. Subprime is contained. Panic phase: 2008. Lehman Brothers collapses. Capitulation phase: 2009. Markets bottom. Renewal phase: 2010 plus. Patient investors rewarded. Stoic response framework. 1. Pre-crisis, denial phase. Build cash reserves, reduce leverage. 2nd. Crisis, panic phase. Execute buy lists of undervalued assets. 3. Post-crisis, renewal phase. Rebalance toward new realities. Wama Katra. 8.2 The Stoic Liquidity Strategy. Liquidity equals optionality. Classic Stoic preparation involves always maintaining 10 to 20% cash equivalents. Pre-identifying crisis buying levels, e.g., I buy Amazon at PE less than 30. Practicing patience. Great opportunities come 2 to 3 times per decade. Warren Buffett's 2008 playbook. Held $44 billion cash pre-crisis. Deployed $28 billion during crisis. Goldman Sachs, GE, Wrigley. Generated 100% plus returns within 24 months. Nabar-Durkos, 8.3 Psychological Fortitude during collapses. Neuroscience shows market crashes trigger the same brain responses as physical threats. Stoic countermeasures. Physical. Deep breathing, 4 to 7 to 8 method before trading. Tactical. Implement 24-hour rule, no sells during panic. Philosophical. Reread Seneca's On Providence during turmoil. Modern example, March 2020, COVID crash. Stoic investors who 1. Paused emotional reactions for 72 hours. 2. Bought quality assets, Microsoft, Apple, at 30% discounts. 3rd, saw 120% plus gains by 2021. Backtest results. This approach delivered 18% annualized returns 2000 to 2020 versus 7% for buy and hold. Sakat, 8.5 Post-crisis integration. The true Stoic test comes after surviving the storm. 1. Profit-taking discipline. Trim positions at preset targets. 2. Lessons. Documentation. Update crisis playbook. 3. Preparation. Reset, rebuild cash reserves. Marcus Aurelius. Insight. The obstacle in the path becomes the path. What stands in the way becomes the way. Asterisk. Chapter 9. The Stoic Mastery of Risk, Beyond Modern Portfolio Theory. Madran, 9.1. The Flaws in Conventional Risk Models. Modern finance relies on flawed assumptions. Gaussian distributions. Markets have fat tails. Correlation stability. All assets correlate in crises. Rational actors. We're emotional beings. Stoic alternative. Taleb's Black Swan Preparedness. Kelly Criterion Position Sizing. Barbell Strategy. Safe assets plus asymmetric bets. 9.2. The Stoic Risk Spectrum. 4 levels of risk consciousness. 1. Naive. Stocks always go up. 2. Conventional, uses standard deviation. 3rd. Stoic, focuses on permanent capital loss. 4th. Master, seeks anti-fragile opportunities. Practical application. Never risk greater than 2% on any single trade. 90% of portfolio in sleep well at night assets. 10% for high conviction, high asymmetry bets. Nagyakamagrakam. 9.3. Stress testing your portfolio. Quarterly Stoic exercise. 1. 1929 scenario. Test minus 89% stocks, minus 60% bonds. 2.0 1970s stagflation test. Minus 40% stocks, minus 30% bonds. 3. 2000.com test. Minus 78% tech stocks. Ray Dalio's approach. Bridgewater simulates every historical crisis daily. Navita Dasans, 9.4. The Stoic Edge in Optionality. True wealth preservation requires geographic diversification, non-correlated jurisdictions, asset class diversification, equities, real assets, crypto, liquidity tiers, immediate cash to long-term illiquid. Modern case study. Investors with 5% Bitcoin allocation saw 2018, 80% drawdown, 2021, plus 1,200% recovery. 9.5. The Risk Journal. Daily entries should track 1. New risks identified. 2. Near misses avoided. 3. Risk rule violations. Seneca's wisdom. Luck is what happens when preparation meets opportunity. Asterisk. Chapter 10. Becoming a Stoic Capitalist. Wealth as a Means to Virtue. Nakasikadachas. 10.1. The Stoic Hierarchy of Wealth. 1. Survival capital, 1-year expenses. 2nd. Freedom capital, 25x expenses. 3. Legacy capital, multi-generational. 4th. Philanthropic capital. Historical model. John D. Rockefeller's wealth phases. Survival, early career. Freedom, Standard Oil. Legacy, foundations. 10.2. The Investor's Virtues. Stoic investing cultivates 1. Wisdom, continuous learning. 2. Courage, conviction during fear. 3. Justice, ethical allocations. 4th. Temperance, avoiding excess. Modern example. Patagonia's Yvon Chouinard transferring company to Earth Trust. Iwadinam. 10.3. The Legacy Letter. Stoic exercise. 1. Write your investment philosophy. 2. Detail key lessons. 3. Specify wealth purpose. 4th. Update annually. Sample excerpt. When markets roar, remember 2008. When markets crash, remember 2009. Your strategy outlives cycles. Asterisk. Lumatasakwa. 10.4. The Stoic Investor's Daily Ritual. Morning. 5-minute market meditation. Review risk exposures. Evening. Journal trades. Read financial history. Monthly. Charity commitment. Mentor meeting. 10.5. The Infinite Game. Mindset. Conventional investors play finite games, quarterly returns. Stoics play the infinite game. Continuous improvement. Multi-generational thinking. Wealth as energy, not accumulation. Final exercise. 1. Calculate your Stoic financial independence number. 2. Build your virtue allocation. Time money to causes. 3. Schedule your first legacy review. Epictetus's closing wisdom. Wealth consists not in having great possessions, but in having few wants. Asterisk. Conclusion: the unshakable investor. The market will always test you, but with Stoic discipline, you'll outlast the impulsive, outthink the emotional, and outperform the reckless. Now go forth and invest like a philosopher.